Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. Equities ended higher last week as fresh data showed weakness in the labor market, strengthening the case for the Federal Reserve to lower interest rates in September. With the mega growers continuing their highs, it continues to be a tale of two markets, making today's guest rethink the bullish broadening thesis. Joining the show today to share his latest market thesis and the macro themes moving markets this week is Fidelity Director of Global Macro Jurrien Timmer. Jurrien points out the dual impact of favorable inflation data and slower job growth, setting the stage for potential Fed action. He also notes the market's relatively calm reaction to recent political events, presenting historical data that suggests presidential elections have limited long-term impact on market returns. Jurrien speaks to the bifurcated nature of the current bull market, where a few mega growers dominate while broader market breadth remains narrow, posing challenges for stock selection as the gap between top-performing stocks and the rest of the market continues to widen. This podcast was recorded on July 8th, 2024.
So is the September cut in the bag? The market seemed to think so.
Yeah, so we had kind of a 1-2 punch of a pretty friendly PCE report, which is the inflation measure that the Fed prefers. So that came in at around 2.7% year over year. So that's certainly an improvement from the much higher readings we got in previous months. And then on top of that, last Friday, we had the jobs report, the payroll report, which still showed, new growth in jobs, but a lesser growth than we've seen in the past, and with some downward revisions as well. And so, with the Fed having a dual mandate of full employment and price stability, both of those indicators moved the needle towards allowing the Fed to really act on its bias to ease. And the markets are now, pricing in a rate cut in September for about 75%. So 75% odds of the first rate cut of the cycle coming in September. So we've talked about this, the Fed's been prudent about not moving too quickly, because it's better to wait a little bit longer than move too quickly and then having to to undo those moves. And as we've talked about, the markets are not hanging on for dear life waiting for those rate cuts. So I think the Fed is in a good position. Jay Powell is testifying in front of Congress this week. I don't know how much he will signal, but I think that's, I think we're getting closer to that pivot actually materializing, because we've been talking about it since the end of last year.
We have certainly been talking about it since the end of last year. I want to ask you also a little bit about the debate, which probably is going to go down in history to a certain extent, the presidential debate that was, and the market reaction, or maybe the lack thereof ultimately. But just if you could walk us through what we did or didn't see, really.
Yeah, so that was, we had fireworks, of course, on the 4th, but that was really the major fireworks in a market that otherwise has been very, very quiet, which actually has been really nice, because when the weather gets nicer, it's nice to have the markets actually kind of be calm, so that we can actually enjoy some time and not stressing over what's happening in the background. But certainly the debate was pretty eye-opening, and obviously we all know what the political firestorm has been since then, and we don't have any answers as of yet. But I take heart that the markets, which of course it's a $45 trillion stock market in the U.S. It's the deepest, most liquid market. It tends to be pretty efficient most of the time. So it's a good sign that the markets were relatively calm. Right. And also, regardless of the outcome, and we've talked about this, and we can pull up slide 6 here. But, if you wait long enough, it doesn't really matter who wins or loses the election, as long as you don't have some kind of, major constitutional crisis. But if you look at the pink bars there in the bottom right-hand side, that's the 4-year annualized price return for the stock market in the U.S. following a presidential election, with consideration for was it a Democrat? Was it a Republican? Was it a sweep? Was it some kind of divided House and Congress and White House? But you can see from the pink bars there that if you wait 4 years, which is a full presidential cycle, the difference almost doesn't matter. It's about a 9% price return, so 11% or so total return, which is the historical average. And so, I don't want to say elections don't matter, but for long-term investors, they don't really sway the outcome. And we tend to focus here on, policies versus politics. And obviously at the policy level, there are going to be differences. And in that sense, maybe one of the reasons why the market did not react very much is because after the debate, certainly, at least according to the pundits, a Republican sweep where the Republicans, win the White House, the House of Representatives, and the Senate, certainly becomes more plausible, right? Because if the Democrats don't have a viable candidate, they may lose turnout, and certainly the Republicans seem to be pretty motivated to turn out. So there you may see some impact. And if you look at the purple bars in this chart, you will see that over the subsequent 2 years, so from this election until the midterm elections, there is quite a bit of dispersion in outcomes. And you'll see that Republican sweep there in the middle is actually one of the better outcomes. So the markets might take some solace in that. And so that's, I think, one other reason why the markets have been so calm.
Speaking of dispersion, or maybe we're looking at this more as spreads, I wonder if you could take us back to something that you spoke about actually quite a lot at the beginning of the year, and then there was almost a beginning of the second quarter story that busted it up a bit. But the bifurcated bull, back to the breadth story, and where we sit now, a bit of a week or so into the second half of the year.
Yeah, so the bifurcation is really starting to reach pretty dramatic proportions. So if we go to slide 1, so at the S&P 500 level, the uptrend is very well defined. You can see it right there. So that is the cap weighted index. You see in the bottom that 66% of the stocks in the S&P are above their 200-day moving average, which is another way of saying that they are in long-term uptrends. So you have, a bona fide bull market. It started in October 2022. It's about 21 months old. It's good for about a 60% cumulative return so far. So certainly all things look good there, but the leadership has become increasingly narrow. So if we take a look at slide 2, which is a daily chart of the S&P 500 equal weighted index, you can see that really, we made a new high back in March, and then we kind of gave it back, and we've just been sitting here in limbo ever since. So the average stock really has not done very much. And so this gets you into the question of, a bullish broadening, or will it be a bearish broadening? And you get into some market math here, right? So the S&P 500 cap weighted index is up 17% year to date. The S&P equal weighted index is up just less than 5%. So if you think of the math, right? So 66% are in uptrend, so that's good. So the bull has broadened, and it is, a relatively normal bull market in the absolute sense of market breadth. But in the relative sense, obviously it's very narrow. Only 29% of stocks are outperforming. And if you look at slide 3, that shows the magnificent, or actually the top 10 versus the bottom 490, and you can see how much that gap continues to open. And if you express that in S&P points, which I've done in this chart, that difference between the top 10 and the bottom 490 is worth about 3,000 S&P points. So it's really a massive, divergence there. But if you think about, we're in the active business here. And so that means we have to pick stocks that will outperform the index. And with the difference between the cap weighted and the equal weighted being so large, it becomes harder and harder for any stock to outperform, right? So if the average stock, let's say, is up 5%, so the equal weighted index, and the index is up 17%, for a stock to outperform the index, it has to go up more than 17% or more than 12 percentage points above where the average stock is. That's a really high hurdle
A lot
to
to
over.
ask.
Yeah, it's a lot to ask, right? So unless you're Nvidia or one of those stocks, if you're just a regular pleb stock, that's a really high hurdle. And so that's why on a relative basis, this is a really tough market. I mean, Fidelity has done well because we've been sort of, we've been part of this sort of AI story. We got it early, but the bar is really high, not for absolute performance, but for relative performance. And it makes me wonder that for the relative broadening to happen, it probably cannot happen without the big mega grower leaders taking a tumble, and that will allow the rest to come up. And so that would suggest that the broadening would happen in a down market and not an up market. And so that's just something to ponder, but that's the relative broadening, not the absolute broadening.
It just, maybe you don't have the numbers at hand, but sort of historically, how often, or how common is that for that spread to come in, and then in a down market you see that?
Yeah, so we go to slide 9, and actually let's go to slide 8 first, and just to indicate again how narrow the market was or has been. So this shows the difference between the equal weighted and the cap weighted index monthly return on the horizontal, and the S&P monthly return on the vertical. And the current circle, which is highlighted there, that's for June. It shows you how far to the left we are of zero, which means that the equal weighted is significantly underperforming the cap weighted, even though the cap weighted index is actually up. So we're getting in pretty rarefied territory. But if we go to slide 9 to answer your question, this goes back to the Nifty 50 story that we've talked about, many times, and I've studied this quite closely over the years. So this is the S&P, and in the bottom, it shows the relative valuation of the top 50, the Nifty 50, versus the bottom 450. And the good news is that the top 50 are only 30% more expensive than the bottom 450. So from a valuation perspective, we are not at an extreme. And that's another way of saying that the relative performance has been largely justified by relative earnings, or until recently at least. And so you compare that to the early 70s, which was the original Nifty 50 period. The premium of the top 50 went to 90%, so they were almost twice as expensive as the rest of the market. And that spread, converged in a market where ultimately valuations got destroyed by inflation. And then when we go to the late 90s, that was a totally different outcome. That really was a bubble. That was the tech bubble, of course, and the relative valuation went to plus 100%. So those top 50 were twice as expensive. And that was a market that went up as it narrowed, much like this one has, and where the convergence of that spread happened in a down market, right? So the PEs converged back to normal. And again, that's not a prediction for what's going to happen here, but it makes me think that at least on a relative basis, the rest of the market may not outperform these Nifty 50 as long as the market is going up, and that it actually may take a down market. And that also feeds into the story, of course, non-US versus US markets, which are just another variation of what we're talking about.
Right, fascinating how this all works. And just to go into one of the biggest of the Mag 5, or certainly the biggest grower this year, how much of an outlier is Nvidia? And therefore, to actually measure it in terms of what it's signaling to the market one way or the other, is that easy, or you just kind of leave it in its own category? What do we take from it?
Yeah, well, I hesitate a little bit in that I'm not a stock analyst, so I know
As a
Nvidia.
phenomena.
Yeah, Nvidia is a market darling. I know that Fidelity has been involved, so this is in no way an indictment of the company or the fundamentals or its leadership. But if we look at slide 12, you can see that the move in Nvidia has been pretty parabolic, for all the right reasons, right? Like the AI story is for real, but still, it raises an eyebrow just to what degree this stock has run. And, I don't want to call it a bubble because I think it's, these stocks have largely been supported by fundamentals and by earnings. And so, by definition, a bubble is a valuation bubble, not just a price that goes up a lot. But still, you compare this to other major sort of parabolic moves, whether it was the Dow in 29 or the NASDAQ in 2000 or Japan in 89, et cetera, you compare Nvidia, which is the black line, and it's really kind of in rarefied territory. And the only stock that I know of that comes close to that actually was RCA back in the 20s, the radio company, when radio was the next big thing. And so it gives me a little pause. And again, that's not a bearish outlook on Nvidia or even the space, but it gives me a little pause that even though the valuation side isn't there to indicate an extreme, the price moves are pretty extreme, and it is kind of a winner take all market where these stocks end up eating everything else and they become so big, and eventually they'll be overloved and overcrowded, and then the earnings growth starts to decline, and then the whole thing kind of starts to unravel, and that's generally how it's been in the past. So again, really hard thing to time, but that was that raised my eyebrows when I pulled up that study.
Yeah, no, fascinating just to sort of look at it on that graph. Here's a question coming in that I think is going directly to what you're speaking about. So maybe you could add to this. Jurrien, is the current overconcentration of a small group of businesses in the S&P 500 a sign of an unhealthy market?
I don't think so, because again, we come back to the chart on slide 1 that shows that 2/3 of the stocks in the S&P are in uptrends, even though only 29% are outperforming, and so 2/3 is about average, right? So it's not great, but it's certainly not concerning that it isn't higher, right? And actually, if we can pull that slide 1 up again, you can see that, for instance, in 2021, that number, the purple bars, reached in the 90s, and even recently it was, in the 80s. And so the fact that it's going down is not really a big deal. You can see how often the market continues to go up, even though the market starts to narrow. So I don't think there's an issue there, but the performance of these handful of mega growers is so much better than the rest of the market that it like we said earlier, it raises the bar so high for your typical stock to have a shot at outperforming the index. So I think it's more of a relative game for asset managers who are trying to outperform an index. That becomes harder to do unless you just pile onto those leading stocks, right? But if you do that, it creates an index effect where everyone is just loading up on Apple and Nvidia and Microsoft, and then at the end of the day, they're overowned, and they're such big stocks, right? These are $3 trillion companies in some cases, and then you get into the danger of the big players own too much of a handful of stocks and not enough of the rest. And then as that mean reversion sets in, which it always has and it always does, even though we don't know when it starts, then it can wreak some havoc at the market index level, where the cap weighted goes down, but it goes down more than the equal weighted. But it doesn't really have anything to do with the fundamentals of the stocks and the companies in the market. It's really just a mathematical problem where a few run away versus the pack. Think of it as cycling. I know we have some cyclists in the audience usually, and you get the peloton, the group, and you get the leaders breaking away. You get a couple of leaders here breaking away in a huge way, and then this massive peloton is sitting behind, and eventually they catch up. And the question is, does the peloton start riding faster, right? Which would be the bullish broadening, or do the pack leaders, get tired and fall back, and then the peloton catches up that way? And that's really the nuance that I'm thinking of, rather than saying this is a really unhealthy, fundamentally unhealthy market.
Okay. Actually, I think you'll love this story. Question. I love this question, but so Jurrien, was there a particular event that caused the tipping point of the PE multiples for the Nifty 50? So going back, where you sort of saw that tipping point.
Yeah, so let's go to slide 10. It's a great question. And, there's really only been two episodes of the Nifty 50. So you have the first one, again, the orange bars now show the PE premium of the top 50 versus the bottom 450. And the top panel shows the actual PE ratios. And you can see in the 70s that it was really a matter of these big companies fell less than the rest of the market because, obviously we had inflation, we had a recession, the 1974 bear market was down 48%. And these companies were seen as a safe haven where investors could hide. And in that sense, the Nifty 50 today were like that back a couple of years ago during, the decline we had in 2022, and even the decline we had during COVID, right? Those were the work from home stocks, etc. And so we've had elements of that happening, but more recently it's been different because the market's on a better footing. The economy is expanding, bear market's over, market's at new highs. So now we're in a different phenomenon where it's really the AI story rather than the kind of, we want to stick with companies that we know are going to grow their earnings. And that borrows a page from the late 90s. So it's kind of a combination of two different cycles. And in the late 90s, again, if we can pull that slide up, it's really interesting because the rest of the market, was trading at, like a 20 PE in 1998, and it stayed there basically while the top 50 went from a 20 PE to a 40 PE, right? And so that was a clear distinction in an up market where the market went up just because these were really big companies and they dragged the index higher, which is very similar to what we're seeing today, even though the PE levels are lower, right? Right now, the top 50 are at a 29 PE and the bottom 450 at a 23 PE. And again, the premium is only 30%. So we're not as extended now as we were then, but in that sense, there is a similarity. So what will be the actual catalyst when this changes? Who knows? It could just be that these stocks become overloved and, you can't accelerate the growth in your earnings forever. Like that's not how it works. So at some point, this space becomes more mature. Maybe there's a competitor that makes a better chip. I mean, who knows what it will be. But right now, it's not extreme enough, even though the price chart suggests it is. But the valuation is not extreme enough to indicate to me that like the alarm bell should be sounding. But that's a little history lesson. And just one more element of this, if we can go to slide 16, that just shows a close-up of the market now, and showing the equal weighted PE in the blue and the cap weighted PE in the orange. And so you can see that there's about a 30% gap, which is similar to what the chart shows that we just had up. And again, it's a gap. It's serious, but it's not yet egregiously so. And also just to kind of give you the glass half full view here, that blue line is not at anywhere near as an extreme, right? The market in the average stock is trading at a 17.7 multiple, which is not expensive, right? I mean, you look at that blue line in that chart, that is not an outlier event. So most of the stocks in the S&P are seeing their earnings grow. Their valuations are pretty reasonable, and the Fed is finally going to pivot here. So it's actually a pretty good backdrop for most stocks. But it becomes a question of what is going to be the catalyst that's going to narrow that gap. And we don't really know what that's going to be.
But it sounds like it could be a cut. I mean, if you've got trading at 17 times forward earnings and not super expensive and you get a cut, I mean, that sounds like a real possibility.
Yeah, absolutely. And if we go to slide 4, I liken the underperformance of most of the market, especially the banks and, real estate. I mean, real estate has its own issues, but stuff that is sensitive to interest rates has been, it has been held back by the Fed's tightening campaign, which, is still ongoing. I mean, the Fed hasn't cut yet. And so you could make the argument, I think, very well that if we get a rate cutting cycle that is not in a recession, right? So a soft landing rate cutting cycle, that lifts this weight that has been sitting on top of the rest of the market for a while now. But the caveat is, of course, that you need to have rate cuts in a soft landing, not a recession. Because if you're in a recession, then those same companies that have weaker balance sheets or are more interest rate sensitive will then have economic problems. And so it's a pretty narrow needle to thread. But it's, so far we are in a soft landing, and the Fed does look poised to ease here. And I'm just showing you this chart here because this shows different takes on the Taylor rule, my interpretations of the Taylor rule. And you can see that all of those squiggly lines are coming down. So there clearly is justification for the Fed to ease policy somewhat.
Okay, fascinating. Quick question here. This is on an asset class that we've spoken about a lot. The discussion of cryptocurrencies. Where you're seeing them now, do you still like them ultimately? Enthusiastic about that overall
Yes.
asset.
Slide 18. That's Bitcoin. That's really the only digital asset that I'm interested in. And I think we're in the band. So that band that you see there is my fair value model based on past adoption curves. This is the internet adoption curve. So past S curves, and then a model around real rates, because obviously Bitcoin, or maybe not obviously, but Bitcoin is trying to be a store of value. So how repressive or easy monetary and fiscal policy should have an impact. And so we're right inside that band. And I think Bitcoin has become efficient enough that you're not going to overshoot as much as we've seen in the past. So you can see that black line is like a pendulum that swings around that fair value. It goes above it in these boom cycles, and it goes below it in these bust cycles. And I think we're now well enough into that fair value band that the marginal buyer is not really going to be interested anymore, because it's at fair value, right? You buy assets when they're cheap and you sell them when they're expensive, but when they're fair value, you just hold them. And I think that's where we are. So I think Bitcoin is becoming less dramatic than it has been. And for a lot of people, that's a real problem. They want the drama, they want the moons, they want the halving story. But I think it's actually a good sign, because it shows that Bitcoin is maturing as an asset class, and it's acting more like gold. And that's really what it should be doing if it's going to be a store of value. And so I think it's all good, but it requires the players in the space that are used to these massive moves to kind of maybe get their thrill somewhere else, because I don't think we're going to see it so much from Bitcoin anymore.
Fascinating. Great place to leave it. Jurrien Timmer, thank you so much for setting up for this week ahead, and for putting many of the events of last week into perspective for us. Have a great week.
Great. Thank you.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on Twitter. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.